Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor at Cooper Financial Investments, and your host for today. As always, I want to introduce you to my amazing co-host, Tony Shore. How's it going, Tony?
All right. Going great, Jose. Great to be here. I'm excited about today's show. It's a biggie. It's going to be a big one. We've got a great special guest, one of my favorite people in the whole wide world. Two of my favorite people are here, Jose, and then our special guest. But yeah, I've had a great week. I went to Omaha, Nebraska this past week. You might think Omaha. Omaha's a great city.
It's great.
I think it's one of the best places. It's one of the best kept secrets. There's a lot going on there. They've completely redone sections of their downtown. There's the Blackstone district. The food choices are amazing. And if you're in the financial industry, it's like a financial capital. I mean, there's Wall Street and then there's Omaha, right?
Omaha, right?
Yeah, I mean, insurance companies and banks, so many national companies are centered there. But anyway, I had a good week. Jose, how about you? Have you been busy?
I've been really busy, taking care of things while Brad is busy with his wife, Shelly, got a new kidney, which is really, really great news. We've just been enjoying it, and he's been enjoying his time now that she's healthy, and it's been a blessing.
Yeah, it's an answer to prayer. I can't believe they were able to make that happen. I mean, there's such a waiting list, and they found someone willing. His sister-in-law, right?
Yes, that's correct. No, his sister, his real sister.
His real sister. Okay, her sister-in-law. That's Shelly's sister-in-law provided it. Brad's sister. That is amazing, and I guess it went well, right?
Yeah, everything went well. She's her kidneys working properly, and they're both healthy right now.
Good. Well, we look forward to getting Brad back, but that's understandable. And you've been really busy though running the show, Jose.
Yeah.
And so I'm glad to have you on the. Yeah, I'm glad to be able to be on the show with you today. I'm glad you were able to host today's show. But now tell us about our show today and introduce our special guests.
Yeah, so today the topic is one of my favorite portfolios, which is the Core Select, which is something we use a lot with our clients. And who better to talk about this topic than the man himself that manages this portfolio, Mr. Keith Gangl.
Thanks for having me. It's awesome. Yeah. No, it's good. Glad to hear all the news about Brad and his wife. It's great to hear. So
amazing.
Yeah, go ahead, fire away with questions. I'm here. I've been doing this for quite a while, and Core Select it's one of your favorites, also one of my favorites as well.
Well, Keith, first tell us what's your title? You're with Gradient Investments. What's your title, and how long have you been doing in the financial world?
Been doing a long time. You could see by my lack of hair on top. So I'm a portfolio manager. I've been doing it for almost 28, 29 years. So I've been with Gradient for 6 years. So it's been a long time. And I worked with our president of Gradient Investments, Mike Binger, for 20 some years at a different company. So it's great to be here. I've been doing the Core Select since I came over. It's about almost 6 years old. So, but shortly after I came over, we started the Core Select, and I've been managing it ever since. So it's we'll get into some details here shortly, but that's my background. Again, that's why I used to have a lot of hair. I worry about the market, so you guys don't have to.
Yeah, right. Yeah. Keith had a full head of hair until 2008.
Yeah,
right. He's lived through a couple of these downturns, and that's where all the hair went.
2000 and 2008 kind of ruined you.
Yeah, I do the worrying again, so you guys don't have to.
That's nice.
Exactly. Well, first, some things that I want to say before we get into some of the nuts and bolts in here. When we say the market, I want to make sure that people understand, people are listening. When we say the market, we mean the S&P 500. And we're going to be throwing that word around a lot. And I want people to understand what we mean by that. Right.
Yeah, that's a great clarification, because a lot of times you'll hear people on the media, whether it's, the podcasts or TV or the newspaper, they refer to the market and they're referring to the S&P 500. So that's a great, I always do when I'm talking about the portfolio as well. That kind of that's a starting point. The starting point is like the market is the S&P 500. No, there's been one around long, the Dow Jones. I mean, that's been around a long time too, but that's 30 stocks versus the 500.
Right. Well, let's start with first, what is the Core Select?
Yeah, so the Core Select, like we just touched on, the S&P 500, It's got 500 names in it. A little known fact, Tony, it's actually about 506. It's not 500. It's fairly close, but they call it the S&P 500, right? Those are the largest kind of U.S. mid to large cap stocks, all U.S. based. So again, that's going to have 500 names in it. Now the Core Select portfolio, again, about 6 years ago, we started this portfolio. We had various portfolios. Some were, value portfolios, such as the G50 portfolio. We had the G33, which is our all growth portfolio, but we didn't have a portfolio that was in between. We wanted a portfolio that looked like the market, right? The S&P 500, but we don't want to own all 500 names. There's plenty of names in that portfolio that,
or 506
are good. Thanks for catching that, paying attention to that. So we don't want to own 506 names. We want to own our kind of range that we own is 50 to 80 of our high quality U.S. companies that we want to own. Currently, right now, I'm at 55. Since I've been managing, it's been a pretty tight range. It's been that 55 to about, I think 61 may have been the highest. So realistically, I would say it's about 60 names, high quality. Again, of the 506 names, there's plenty of names I don't want to own. And there's plenty of names that I want to own. I want to own a lot of them. I mean, you certainly, we've had a nice run the last couple of years, and a lot of it is because I owned a lot of these NVIDIAs of the world, the Microsofts, the Amazon, these high quality everyday names. Those are names you'll find in the portfolio. But
so the Core Select's done well, is what you're saying.
It's done. Yes, it's done very well, which is it's nice, right? That's kind of the plan out front, and we've been executing on that. And another thing we talk about, so that the mainframe is going to have 50 to 80 names, U.S. high quality names. And like I said, we have value portfolio, we have a growth portfolio, but the Core Select is going to have characteristics of all that. We're going to have roughly, you can think about a third of that portfolio being growth names, a third of that portfolio will be in value names, and a third of that will be in core, which is kind of the middle. It's going to have characteristics of, not super growthy, but not really, really cheap or pay a big dividend. An example of the name I like to give people there is Costco. Tony, you ever been to Costco?
A few times. Yeah.
That's one of my favorite places to shop personally. My wife hates it, but it's been a great stock. It's a phenomenal name, but it doesn't have high growth characteristics as some of these technology names I mentioned earlier. And it's not cheap and doesn't pay a big enough dividend to be paying, put into like a G50 portfolio. So there's certain names like that and Visa that we couldn't own here at Gradient because we didn't have a portfolio that fit. If we're investing in an all growth portfolio, we want it to be all growth. If we're investing into a portfolio that pays a lot of dividend, that's what we want to be. But the nice thing about the Core Select, is, it's I call it all weather portfolio. We can have, if I want to have more than a third of growth, if I really like that, I can go up to 40, 45%, even more if I really think growth can outperform the rest of the market. So that's the nice thing. It's actively managed as well. So those are kind of the key, points of the Core Select.
Yeah, and from when I talk with clients, the way I sometimes explain it, because this term is somewhat popular nowadays, now that a lot of the regular public is getting to investing, is direct indexing, where you pretty much try to create the S&P 500 on your own terms, right? Yep. You pick the best 55 to 60 and you kind of trim out the fat out of the 500, right? Yep. Would that be a fair explanation?
That's exactly right. I don't want to own them all. There's plenty of names that I don't think are that great. Mm-hmm. And, so I'm going to own the 55, 60 names that I think will outperform the overall market, right? And again, I mentioned some of those names I own, and it's going to be a blend, and we're actively managed. So then there'll be periods when all of a sudden I think something's done really, really well, and I want to sell it because maybe valuation's too high. Or like if you're in a passive index, it's just going to continue to hold it until a correction happens. But hopefully, if I'm doing things well enough, we can, buy low, sell high. That's the objective of investing, and that's why we like active investment.
And over the past 5 years, how using the market, the S&P 500 as a benchmark, how has the Core Select done against?
Yeah, it's actually since inception in the 5 year, 1 year, and 3 year, I think we've been slightly outperforming it. And then this last year and a half, we've had a really nice run in it. So it's been more than slightly outperforming it. It's been off to a strong start this year as well. So
when you say outperforming the S&P.
Yes, exactly. When I'm talking about the outperforming, right? Because we look at the S&P, can you talk about indexing? That's what we we benchmark against the S&P 500. So my name, how I judge myself, how do I know if I'm doing a good job picking stocks? So one of the ways is, there's several different ways, but one of the obvious ways is, am I outperforming the S&P 500? Am I picking 50, 60, 80 names better than what's in the market? So that's our goal, and we've been doing that since inception, which is nice because there's certain stats out there. It's difficult to beat the S&P 500, but knock on wood, fortunately, we've been doing that, and we continue to hopefully strive to do that going forward.
Yeah, I hear from a
let's
lot of
knock on wood
advisors.
that keeps happening.
Yeah, I hear from a lot of advisors, Jose, like yourself. You probably hear this from people coming in. Why didn't they want to? Hey, the S&P 500 makes this much every year, but I'm only making this much. Why can't I make as much as the S&P 500? That's a common sentiment amongst investors, isn't it?
It is. It is.
One of the reasons is I think people, I've been doing it for a long time, kind of using, a little bit of my experiences. When things tend to go really, really well, people start piling in or chasing performance. If you ever heard that terminology, people are chasing performance. And so when that happens, they may ride the wave for a little while, but then ends up rolling over. And if you're not actively kind of pulling back some of your winners and putting in some of the stocks that are underperforming, that could lead to underperformance. There's been various studies out there. JP Morgan does a great one that we always, show our, investors and advisors, is that, the average investor actually underperforms the S&P 500 by a fairly significant amount. And this is like a 20-year study. And the reason I do that is because they chase performance. That's one thing I try to do is, again, it's not easy, right, to sell winners and try to buy something that's underperforming. You have to be careful, right, because you can fall into, a bear trap and that type of thing. So, but that's, the part of active management. That's kind of what hopefully I'm bringing to the Core Select.
Good. And one of the things that is kind of the talk right now, especially this week, is the Federal Reserve, which would have whatever the Federal Reserve says or does have an effect over the overall market and also the Core Select. Right? Back in March, you mentioned that the Federal Reserve, you could expect the Federal Reserve to cut about 2 to 3 times this year, but a lot has changed since March. But how has your opinion now changed since that last interview you had at Yahoo Finance?
Yeah, sure has. And it's great that you're keeping up on that stuff. If we go back to the beginning of the year, expectations, not my expectation, but the overall consensus was for 6 to 7 cuts this year. We thought that was way too high. And we were more in that 2 to 3 range. The reason we were in 2 to 3 range is because we thought the economy was doing very well, and it was, right? And we thought inflation was going to stay somewhat sticky, and that's certainly what the case is right now. So the Federal Reserve is going to actually start cutting when 2 things can happen. It's when inflation rates peaked at, a year and a half, almost 2 years ago now in June. It was actually be 2 years ago. It was at 9.1%. And currently now we're at, 3.4%. If we go back last June, just a year ago, we're at 3. So we've been bouncing between that 3 and 3.5% for the last year, with the Fed's goal of getting down towards 2. So when the Fed gets closer to 2, they can start cutting rates. And we thought this last, mile of getting inflation under control would take a while. And that's exactly what's playing out. Now, take it back. That's why I said in March that we do 2 to 3. I think the economy remains strong as well. So there's no reason to cut. And so I'm more in the camp. I think the expectation now from 2 to 3 is actually probably 1 to 2 as of, these Fed dot plot stuff that the consensus experts are saying. I'm more in the camp that's going to be 0 to 1. And 0 would not surprise me at all. So that's one thing we actually even kind of gave as an outlier situation at the beginning of this year, is that it would not be surprising to see 0. And that, in my mind, that's not a bad thing. That means the economy is doing very, very well. So the Fed doesn't have to come in and actually help stabilize the thing. So the thing that you're probably getting at is investors' expectation is what happens or why we're so focused on the Fed. I'd rather be focused on earnings. I think long term, that's how the S&P follows, earnings. So if earnings remain strong, that's a good thing. And I think that's why the market's held in as well as it has. It did have a little, you and I have talked in the past, it had a little bit of a kind of strong start to the year. It was up almost 11%, sold off about 5% right after the first quarter. And that's when kind of people are realizing, oh, wait, economy's too strong. We're not going to cut. Market throws a little tantrum, sells off about 5%. Now I think people have got to readjust. And I think that 1 to 2 is more realistic. And I still think it's a little high, but at least it's a lot closer to where it was. And I think people are like taking a deep breath, and we're setting all-time highs on the market, Tony. You saw that, right?
Yeah.
You probably looked at your 401k and your savings. Like it's always nice.
Yeah, it's good to see the bump. Yeah.
It's always nice to see a little bit of a bump there.
Yeah.
So,
yeah.
And I think that's not due to the Fed. So we're starting to shift away from the focus off the Fed and more to corporate earnings, exactly as an investment professional that I want to see. I don't want just one person or one group of people to be able to control what's going on in the market.
Right. And that investor expectation caveat that where a lot of just regular retail investors, your regular Joe in the street probably got hurt from that March meeting where for some, I don't know where they thought it was okay to expect that the Federal Reserve was going to cut interest rates in March, but for some reason, a lot of people were expecting that.
Yeah.
And they were disappointed, and they probably started selling off, and that wasn't really from a professional investor standpoint, wasn't really a smart idea, was it?
No, but there was certainly a lot of professionals that thought we were going to get. I mean, when I talk about consensus setting at 6 to 7, those are professional, U.S. economists. So those are guys that are doing this full time, expecting that. And what I think the problem they had is, if you go back a year ago, they were expecting a recession. Remember that talk, Tony? Just maybe 18 months ago, it was like everybody's convinced that in 2023 we'd have a recession.
Yeah, for about 3 years they kept saying we're going to hit a big recession. Yeah. We're going to hit a big recession because of the inverted yield curve and things like that. But it really didn't happen.
No, it didn't happen. Yeah. And with things that we look at to keep, the overall, we think earnings is the biggest thing to drive the overall stock market. And the other thing is we look at the consumer. Consumer drives, 2/3 of the overall GDP growth rate. And the consumers are, people like you and I. So if we're working, unemployment is really low. We're almost at a 50-year low. So it's very, very low. And so when people are working, they have money in their pocket. They love to spend. And that was our argument all of last year. And that's the same thing this year. But I mean, you're starting to see little cracks in the consumer. So we have to be a little bit careful. I can't be Pollyannish and say everything's going to be great. It's all good. Earnings are going up. But consumers getting a little bit stretched, but I still think there's mixed data points. We had a strong jobs number last week, which is really phenomenal. So that's if people, again, are working. And the other thing we talked about inflation coming down. We're at 3.4%. Later this week, we're also going to see that. We're going to have the FOMC meeting coming out saying, are they going to raise rates or cut rates or do nothing? I think the probability now of them doing zero is very, very, very high. So I don't think that anything happens there. And then the CPI is looking for 3.4%, which would be, again, kind of flat with last year. And I gave you that range of 3 to 3.5. We're still in that range. We're not getting sub 3 to get to that 2 where we think the Feds are closer to cutting rates. So I think we got some big data points coming up this week.
Yeah. Do you think it'll be reasonable to get below that 3% by the end of the year, or probably next year, early next year?
That's a great question. I would say it's going to be next year, and I wouldn't even think it may not even be early part. It could be second half of next year. I mean, it's that last mile, just like in anything. If whether you're building a house or something, it just seems like the detail work to the last piece. Going from that rapid increase from that 2% to 9.1%, and then down now from it went from 9.1 to that 3.5 very, very quickly. Now, if expectations are that we would have a linear line, that's not realistic. So I think part of that is because going back to COVID, the government's pumped a lot of money into the system, right? And then with the Federal Reserve, they also had zero interest rate policy for a long time. So the other thing about interest rate policy is if you go back and look at a 20-year history, the Fed funds rate at 5.25 is not that terribly wrong from a long term. But if we look at the last decade when Fed had zero policy, then we're a little bit off that. But it could maybe that 5.25 goes down to 3.5, and we don't go back to zero. I don't think that's a bad situation though either.
Yeah, I've heard that. But it's funny you mentioned the last mile is always the hardest. I remember, how about when you were in school on a Friday, waiting for the 3:00 bell to ring? I'll tell you what, that the last half hour drags by, and boy, that last 5 minutes lasts about an hour.
Yeah,
it felt like
that's a great analogy. I think we're in that last 10 minutes before 3:00, so we're kind of dragging here, and it could last. Like I said, I would be shocked if we get there this year, and again, we're halfway through the year, and it doesn't seem like we're going to drop that quickly. Because right now, when we drop, it's usually 1 or 2 tenths, and we're at 3.4, so it would be a pretty big move to get all the way down to 2. But directionally, if they start getting even, mid 2s, I think that will give the Fed green light to cut rates if that's what people want. I just don't want them cutting rates they can do it for several different reasons. I just don't want to do it because it's a slow economy, because I think that's bad for everybody. Because then unemployment goes up, and then people have less money, and there goes my argument of saying the U.S. economy is totally dependent on the U.S. consumer.
Yeah, and if they do cut interest rates, even in this year, let's say around November after the election or sometime around that, it probably wouldn't be by much.
No, and then again, so it's like realistically, is like going from 5.25 to 5 or 4.75 do a whole lot. No, the only thing it gives investors is we've gone from raising rates to this long period of pause to now the next phase will be probably a gradual slope down. The question, once they do actually start cutting maybe a quarter, the question will be how far are they going to go? In my mind, like I just mentioned, I think they probably maybe it's going to be, again, there's so many variables, but if I look at longer term, I just don't think we're going to go as low as we were at 0. I think it's going to be more like that 3.5%. So, I mean, that's still 1.75 to cut. So that could be over the course of several years. And again, opinions vary, right? I mean, if we just go back 6 months ago, there was a lot of people calling for a lot of cuts. I prefer not to see them. And again, the market has proven out this year that, discounts forward, economy remains strong. Our GDP forecast, or the forecast out there, I think for 2.4% GDP growth rate. Again, so GDP growth rate between 1 and 3, that's historical normals. At 2.4, that's a healthy market. So unemployment, we just saw that ticked up a titch last Friday, is at 4%. So it has a 4 handle on it now. But again, the 50-year low is at 3.5%. So or 3.4, I think the exact number is. But we're basically, if you want a job, you can find a job. So I think that's the case. There might be some skills mismatch of a job that you want that don't get, but for the most part, if you want to find something, you can find something.
Right. And I think the ratio is that there's usually more jobs available right now than people looking for a job. Is that correct?
And that's called a JOLT survey, which looks at the openings of jobs out there. And funny you mentioned that, because we always said for the last 6-12 months that we think that's overstated. Like when a company's looking for a job, a lot of times if you remember Tony here just a year and a half ago, it was hard finding people for a lot of people were quitting, and they would go get a bigger raise somewhere else. And every company's having the same problem. People are chasing bodies. That doesn't seem to be the case in the last 6 to 12 months.
Yeah, and like you said, job growth has went up, right, guys?
Yeah, and then the JOLT surveys looks at how many people are at postings out there. So if you look at last year, it was like 11 million openings for, I think the number of people unemployed was like 5 or 6. So it's 2 times the number of openings for people looking for jobs. Now that number has actually dropped to the JOLT survey. It's just people, they survey companies to see how many openings they have. But that's down to 8 million. So that's a lot closer. And so I think that's more realistic. We're telling people we think that 11 million is overstated. I think the 8 million is even a little bit overstated, because typically when you want to hire someone, you maybe have a couple job openings out there. And then when you hire one, you maybe, we got one. Now maybe we don't need that second one. We want to have 2 just in case we get some good qualified candidates, and maybe we'd make room for them. But if not, I think we can operate. So I think now we're closer to equilibrium, and that's where, I wouldn't be surprised that unemployment ticks up from 4% to 4.5%. The 20-year average is like 5.5%. So again, still below that.
Still very healthy number. But let's say, play this hypothetical here. But let's say that the Federal Reserve does cut the interest rates late this year, around November, December, and they cut it, I would say, 15 basis points, maybe.
15?
Yeah.
No, just
you think that'd be more?
No, if they do it in quarters, just so you know that historically they have it in quarters. So really? It'd be 25 or 50. They don't usually do that.
Okay. 50. So I mean, on the lower end then.
Yes, it would be on the low end. And then like I said, I think it's going to be 0 or 1 for this year, and I'm leaning towards 0. And I would say, even if they're going to do one, I would say it's going to be after the election. The other thing that we didn't talk about, which I don't really want to talk about politics, but the Fed doesn't want to seem political. So I think if they're close to deciding that they could potentially cut or not cut before the election. So we literally have this week, there's an FOMC meeting, something happened. The probability right now, I think, is like 99% they do nothing. So then we have 2 more meetings before the election, which, beginning of November. And I think the probability of them cutting between now and then is very, very low. In my mind, I think it's 0. And then if the economy does start slowing, I think they would wait till right after the election. And again, there's one, I think, literally like days after the election at the beginning of November.
In November, like you were saying.
Yeah, I think they could cut there, and then there's one at the end of the year for December. And again, what is 25 basis points? Not really nothing in the big picture of things, but it just gives you an indication of where the Fed's going, which is where investors kind of, they'll run a straight line on saying, well, we did 25, now we're going to do 100 over the next year. And so that'll be some ammunition for the markets to continue to do better. Again, depends on where the markets are at as well.
Right. And I guess the question is if they do, how would that affect the market? Do you think
so in November, he's saying in November, if they do raise it a quarter, or if they do look,
hopefully if they do raise it, so, the markets will get nervous.
No, that'll be bad.
Yeah.
But if they cut interest rates by a quarter, how does that affect the market?
Yeah, that's a great
question.
That's a great question, because it's not just, in my mind, like I said, I'm looking at corporate earnings, so it's like that's a bigger driver. So a quarter cut, it's like, okay, so my loan rate, if you're looking for an auto or your housing, like, let's start with the mortgage rates. Everybody can relate to that. 30-year mortgage right now is around 7%. So they do a quarter cut, and that's based on a 10-year treasury yield, and so that comes down a little bit. So maybe that goes to 675, 650. That's incrementally going to help a person buy a house, but it's not going to go from 7 down to 3 on a quarter basis point cut.
Mm-hmm.
It just doesn't work that way. So I think it's more of looking out in the future that kind of things are going to get, the Fed's going to be a little more dovish, which means they're going to help boost the overall economy. But 25 basis points doesn't mean much. It's going to be a lot around the language too. If they just indicate 25, we're going to do a wait and hold like we've been in for the last almost a year of waiting period. That's fine. In my mind, that's fine. I'm going to be more concerned about, is the economy still growing? We're looking at corporate earnings. We just got done with our earnings season here. This first quarter earnings got reported. They were generally very, very good. And earnings forecast for the overall S&P 500, those 500 companies we talked about, that actually increased a little bit. And most people thought going into earnings season that was actually going to go down. So again, it'd be nice if we didn't have to talk about the Fed anymore. We start focusing on what were the earnings out of NVIDIA and Walmart and Home Depot and Lowe's and stuff like that. That's kind of what I do as a PM. We look at the macro as well. Obviously, we didn't know what the Fed's doing, but the farther we can get away from investment decisions made on the Fed, I think the better off we all will be.
Right. I agree. Well, I think are we up in time here?
Yeah, we're about out of time, but that Core Select, that's a great portfolio as far as, and you manage that portfolio. I think that's important. And I'm glad we talked about that today. Jose, great questions for our guest today. Keith, I think that was great to have you on.
Thanks for having me on.
Yeah. Before we go, Jose, let our listeners know how they can get a hold of you if they want to set up a consultation. And our listeners should know Jose has a direct line to Keith to talk about investments and these things for them personally, for their personal situation.
Exactly. Yeah. And I would love to direct all of the listeners to our website, cooperfinancial.com, and also give us a call at 888-390-5277. That way you can schedule a call with me or schedule an appointment to come in.
All right. Sounds good. And that does it for today's episode of the Financial Armor Show with our host, Jose Rodriguez.
Thanks, guys.
Thanks.
Thank you.
Great job, Jose. Like an old pro.
All right.